Welcome to What Would It Cost? Today we're here with two individuals that are very inspiring and are doing amazing in the real estate trade, Mr. Daniel Foch and Tyler McLay.
Yeah, welcome to the show, guys.
Thanks for having us.
Thank you. Yeah, thanks for the kind words.
Yeah, no problem at all. Yeah, and on today's episode, we're going to look into getting into what the market currently looks like, what that outlook is, and just, you're both very different opinions on that. But before we get into that, tell us a bit about your background, getting into real estate, and just a bit about yourselves.
Sure, yeah, I can start. Daniel Foch, real estate broker. Been in the business for about 10 years. Probably been in it my whole life. Really, grew up in a real estate family. I think you're similar too,
Same,
right? Yeah. Prior to starting as a broker, worked for commercial real estate firms and in real estate investment trusts. So, heavily analytical, obviously, on that side of things. Right now, I represent primarily investors, and I'm the host of the Canadian Real Estate Investor podcast. So, that's my clientele, and that's really the part of the market that I'm in touch with, for sure.
Awesome. How about yourself, Tyler?
Tons of respect for Daniel. Love a lot of what he puts out there. But yeah, Tyler McLay, third generation realtor in Toronto, GTA. My background is same thing. Grew up with it, immersed in it since birth, if you will, but been practicing for about 10 years as well. Got my background is finance.
Right.
Similar. Master's of Real Estate from Schulich School of Business. I now manage and coach my team of 9 total, including myself. And we are pretty thrilled with the results we're having in the market and the feedback from our clientele. That's me.
That's awesome,
man.
Love
Very
it.
Cool.
Love it. So we got, the bull and the bear. So let's get into that, seeing how we've come off that COVID high. What are you guys seeing right now in the market, and where you expect it to go in the next, let's say quarter to even out to a year?
Yeah, I think we're running at basically a 20-year low on volume, which eventually should materialize in declines in price. But the reality is we're seeing record low inventory volume as well. So there's no supply demand imbalance yet. We're still technically maybe we're heading towards a balanced market, but we're still technically in a state of excess demand. So price has been sticky on the way down. We saw maybe almost an overcorrection in response to the buying power that was erased as a result of Bank of Canada's rate hiking cycle. Price is down anywhere from 20 to 30%, depending where you are in the Greater Toronto area. But that seems to have stabilized for the past couple of months. Since July, I'd say we seem to have hit a plateau on the downward price discovery. And I would expect that'll probably continue until Christmas time.
Right.
And then I think next year, it's anyone's game. Depends what happens with inflation and interest rates. But if rates keep going high and we start to see that materialize in the buying power of the average purchaser, then I would imagine prices could potentially grind lower. And I guess we'll see.
Yeah, absolutely.
I think it's a lot of that, right? No one's got that crystal ball. We don't know for sure. All we can do is look at stats, numbers, and make educated predictions, right? And a lot of this forward thinking and market outlook comes from a background of, the history of the market and what's going on with inflation and interest rates. Of course, the only tool to combat this runaway inflation is interest rate hikes. Right? Reducing that access to capital. So I think that one of the examples I use is kind of that first snowfall of winter. Everyone's running around like a chicken with their head cut off. They don't know what to do. They forget what winter is like, right? Relatively to, it's been a whole year. Where are my winter boots? Where's my Canada Goose? Are my winter tires on yet? I don't know. But by the third, fourth snowfall, oh yeah, this is what we're used to. We know what Canadian winters are like. Yeah. And that's what's happening. Just relatively to that COVID craziness, which is unrealistic and unsustainable, right? Oh, but Ty, it can't continue. Well, obviously, right? You don't have to be a rocket scientist to tell me that it's unrealistic for the market to continue 20, 30, 50% year over year price increases. But there was indicators there as to why that was happening. Money was super cheap, and access to capital was cheap.
Yeah. Right. So we're all locked in our houses, contemplating how much we hated them. Yeah.
That's it.
And there's nothing else to do.
Saving money.
Right?
Yeah. Exactly.
Because a lot of these people that were
hike
home.
in pools. People putting in pools. It's like,
correct.
I can't go anywhere.
Can't go anywhere. Cottage market, right? First thing in an economic downturn, people sell cottages and fancy cars, right? The third family car. But we saw the complete opposite because there were other factors at play. And I think that's the biggest thing as Daniel and I go back and forth. I think there's different things to look at, different things to analyze. And if you pigeonhole yourself into one or two economic indicators, you're going to have a totally different view from looking at another one or two economic indicators. It's important to look at that whole pool, right? Like we talk about people being home. I think a lot of the people that lost their jobs as a result of COVID it was that service industry, right? Which are, for the most part, renters, not homeowners.
Right.
You're looking at service staff, airline staff, hospitality industry. Those individuals don't impact the real estate market as much as, buddy working in BMO Capital Markets who's working from home, still getting paid, still has an income, just less opportunities to spend that money. Right. So you saw Canadians and Torontonians savings drastically go up. So more money in the bank and no places to spend it, basically.
Right.
It's a big factor.
Great point. And in regards to so you look at the supply and demand issue as is, and you look at us tripling up and the 1.5 coming in on the immigration side of things in the next 3 years, and then if you zoom out a bit, you look at that 10, 15-year linear graph, right? And you blend all that together, right? And you take a look at it from an investor standpoint, right? Where is this the bottom of the top, right? Is it something where it's a good time to inject capital in the market? We're seeing it on the financing side of things that people were stacking their chips the last couple of years.
Sure.
The investors were stacking their chips the last couple of years because they knew something was coming in around the corner that was going to be, something that was a yard sale, right? They're getting in for, to go to your point, 20, 30% down on $1 million property brings it to 700,000-800,000. It's a lot, cheaper of a ticket into the market. And as they continue to scale their portfolios, they're doing so for a song and a dance instead of them getting in a couple years ago, which would have been a lot more pricier for them, right? So what's your take on when that bottom continues to drop lower? When does the foreign investor come in and say, hey, this is way too low for the GTA and it's going to come right back up because of all these things that are happening, and they inject capital in it, and because they know that they're all at the starting line. We feel they're all at the starting line, kind of like, okay, it's low enough, and if it drops any more, right, then we're not going to get in at the right time.
The urgency is gone, right? That urgency is evaporated.
What's your take on that? I would love to hear it.
Yeah, I think if you're thinking about it from a purely investment perspective, I guess you really have to compartmentalize Canadian real estate into two different components. So there's speculators, which is like the second home buyer, the people who think that they're a rocket scientist because their house went up 30% year over year for the past 2 years, and they're like, shit, I'm good at this. I'm going to go lever up and buy an investment property. Right. And then now they're levered up and they're exposed to this market and they're getting smoked in the downturn. That's a speculator. Yeah. Let's just put that one aside.
People forgot the fundamentals, basically.
Right. Absolutely.
Right? People, rising tides raise all boats. People forgot the fundamentals and just bought anything and everything, right?
For sure, for sure. FOMO. And so,
Fear of missing out, right?
Yeah, 100%. Yeah, that was definitely predicated on that, a FOMO mentality in the market, I would say. So then there's investors, and investors, we know how investors behave. There's a lot of data available on that. So if you look at the national average cap rate for Canadian real estate for the past 25 years, it's about 410 to 450 basis points above the Canada 10-year bond yield. So we know what investors' expectations are on price. They're not even close to there yet. So investors' price expectations, as interest rates go up, investors' cap rate expectation goes up, which means their price expectation goes down. So right now, as long as the Canada 10-year is moving up, investors' price expectations are going down. Now it's kind of stabilized, but cap rates still aren't at 7%.
Right.
And so I think that when the economics make sense for investors, there absolutely will be a rushing in of opportunism. And I'm getting calls from investors on a regular basis saying, I'm hunting for deals right now, but nobody's really papering them at scale, let's say.
Right.
I do think investors will establish the price floor in the market, but it's definitely early. So to answer your question, when returns get to the point where they're compelling for real investors, not speculators, real investors to make money in the Canadian real estate market, that's when that floor will be established. That's my perspective.
Right. And you're saying that's in and around a 7 cap.
I think nationally, so like in the Greater Toronto area, like you'd have to average it out.
Compressed in Toronto.
Yeah. Huge. So like Toronto, I listed a fiveplex, like a mixed use fiveplex in Toronto 2 or 3 days ago at like a 3.5 cap. Add value, maybe you could stabilize that at like a 5% cap rate.
Right.
I think like Toronto will stay in a 4 or 5 probably cap rate range during a downturn comfortably. But condominiums and like cash negative rentals don't really factor into that. Those are more speculative, and that element of the market is really being attacked right now by the lack of appreciation. Even if you're right and prices go up, they're not going up at 30% year over year, right?
No chance.
Right. And so
it's not realistic,
right? And so speculation, I think trading real estate is is gone as a money making vehicle. Real estate is no longer a get rich quick scheme in Canada. It might return to us having a healthy relationship and having a get rich slow scheme for real investment for the next decade, I think.
Which the sophisticated investors understand and get
100%.
that from a real estate perspective. But that fear of missing out that you spoke about, everybody and their cousin was saying, we got to get in on this. We can't miss out on this opportunity. We're going to miss that boat, right? So, some people bought closer to that peak that we saw January, February of this year, earlier this year, but it's a long-term game. It's a long-term investment. And yeah, we can talk about the different asset classes from a fiveplex to a condo, and it's a different investor, right?
Yeah.
It's a much different investor. At least it should be for those that understand where they want to be. There's cash flow, and you can compress cap rates with increasing your rents, which the rents are going up like crazy in Toronto specifically. If you're a condo buyer, you're probably a little more on that from that spectrum between cash flow and spec appreciation. You're close to that appreciation side, right? You're banking on the growth of Toronto, the city, the job growth, the population growth, which is expansive. The latest statistic that I read is a 98% population increase, so almost 100% population increase by 2041. In the big scheme of things, that's not far away, right? So where are these people going to live? And when you look at that adding of supply to market, right? So everyone's caught up on interest rates and inflation. Those are the buzzwords of the last 6 months, right? But we forgot about all the supply conversations we were having 6 months and prior.
Right.
So to add supply to this market is no easy task. And I think that's one of the biggest things that's going to maintain the resiliency of our Toronto market. I think that's one of the most special things about Toronto. I just got off the phone before this with a New York investor, and he was just so bullish and excited about the Toronto market because of, I guess, the global conversations that are happening, right? The population increase, the job growth, but the lack of, adding supply. It's very difficult to add supply in our market. The permits, the average time, fun fact, and so without getting into hardcore nitty gritty numbers, the average time, if I buy a gas station on the corner of downtown Toronto core, right, King and Spadina, by the gas station where my billboard is. Check it out if you haven't seen it. You buy that gas station, from the minute I close on that property to the minute that you're walking into your penthouse on the 50th floor, 7 to 8 year span. Wow. So you want to add supply to this market. The government wants to add supply and tackle this affordability crisis. Make it easier for developers to add supply. They're making it tougher. Development charges just went up 50%. That's going to be passed on to the end user, right? So you tell me, how can we not be at the floor of where we're going, right? You want to talk about the next 3, 4, 6, even 12 months? That's short term, man, from a real estate perspective. I don't care. If I'm a real estate investor, as you said, it's not a get-rich-quick scheme. Like, those days are over and never should have existed. This was a crazy event, this COVID thing. I don't even want to say the word. It's like Voldemort. You don't want to say it, right? Just the thing that happened. But anyway, I think there's so many other factors at play. Huge one being supply. It's so difficult to add supply to market. And what's there is there, and what's coming is scarce, right? It's going to be a more rare asset, generally, home ownership. Right? You look at major markets, London, Singapore, Tokyo. People don't own their real estate. It's their rental markets.
And I think that's the end game here. Realistically, you could analyze Canada, and most of the Western world has gone through the same trajectory. When you're a destination where the majority of people in the world would love to move to your country, we saw this happen in Europe. Eventually, you end up in a state of excess supply for so long that your economy becomes a renter's economy. You look at Switzerland, you look at Frankfurt. Young people don't own houses. If you live in an urban area, you rent. And then in the suburban areas, there's multi-generational ownership. That's why they have 40, 50, 100-year mortgages, and people pass down homes from generation to generation. Home ownership, and this is the funny part, like, we have this obsession with home ownership in Canada, but the reality is most of my friends, like, I'm half Swiss, so I have family there. I spent time doing military conscription. So all of my friends who I was in the army with in Switzerland are probably wealthier than I am and wealthier than anybody I know in Canada. And maybe it's because they're Swiss in Switzerland. But the big part is that they invest in things outside of housing. They're not obsessed with this debt servicing of, paying off a house. They invest. They invest their money well. And I think that in order for us as young Canadians especially to have a healthy relationship with housing, we need to stop thinking about the principal residence as an asset, or because it's more akin to a liability at the beginning, right? Until you've got basically greater than 50% of your mortgage paid off, it's really just debt service. That's all it is, right?
No one really teaches smart saving or investing, though, really. So for the majority of these baby boomers that are coming up on retiring, are the ones fortunate enough to be retiring and don't have to continue to work to service that debt, that's their nest egg. Like that's their retirement fund. And you get into these reverse mortgages, and it's forced savings, right? I can tell you most people I know that make a certain income spend probably that same income, if not more. They're not in that frame of mind to save, to invest, and get into those habits, right?
Yeah,
so I think that principal residence piece, especially in Canada and Toronto specifically, that's the nest egg. Like that's the retirement. That's what you have. And if you don't have that, then you get into, who's paying for the homes and the food when people stop working, and retirement age gets pushed back, and people aren't retiring, and there's no room for new jobs, and it goes on and on and on, and it's a terrible cycle. So I'm more prone to say that it's a necessary evil, and not even necessary evil. Interest rates are all relative, right? Relatively, our interest rates are still super low, I think. The cost of borrow is still super low. And I'm not saying, back in the 70s and the 80s, like, who cares? It's totally irrelevant now.
Right.
But the cost to borrow and the upside potential of that borrowing, that leveraging, there's just so much potential there. And it's just that relative piece that I think. It's like when you see guys wearing shorts in the spring because it's like, we're coming out of negative 30-degree weather. But in that same weather in the fall, it's like, shit, it's cold, man. Right? But it's the same weather. It's just what you're coming out of.
Right.
And we're coming out of ultra low rates, and it's like, whoa. So that's my take. But take a step back.
It is funny. Okay. Yeah, I mean, rates relative to inflation are low at this point still. Right, like you can still borrow at net negative money. Like, so the financially responsible thing to do is to lever up and just go spend money on anything,
100%,
literally anything, because it's going to be inflated by this time next year.
Simple math. You have to hedge that inflation, right? So I agree. We're agreeing more than we're disagreeing. Wild.
Wrong here?
That was good. So interesting.
Yeah, awesome. Yeah. So we're going to take a short break. We're going to get to commercial, and hopefully when we come back, we'll get you disagreeing on a couple things. We'll be right back.
Escaping the concrete jungle to cottage country is high on the wish list for many Canadians. SparkFinancialGroup.ca is here to help you secure the best rate on your mortgage for a waterfront home or countryside dwelling. Spark Financial Group, where finance creates freedom.
Welcome back to What Would It Cost? Today we're sitting with Daniel Foch and Tyler McLay, and we're going to get right back into it.
The $1 million question that everybody's asking all these investors, first-time home buyers, 1 year from now, prices up or prices down? What do you guys think?
Down.
Down? Up. All right, we'll start with you, Daniel. Why down?
I think we haven't seen a market in which we've been exposed to rates that are higher than what they were this time last year for a long period of time. Like, we're still actually operating on rate holds. You guys would know this better than anybody else. We're still operating on rate holds from 90 days ago, up to 90 days ago. So you're looking at people buying with a 3.5 to 4.5 probably.
Yep. Yeah.
Eventually, we're going to have people that are buying in the 5 to 6 range and qualifying at
7.5%.
7.5%.
Yeah.
The buying power has been reduced by 30 to 40%, and prices are only down 20 to 30%. I do think that the Toronto market came down too fast, too quickly, and it was almost like it was forward-looking. And now we're seeing that it's flattening a little bit. It's a more sophisticated market. It priced everything in early, flattened, but it's going to grind lower. And you see this happen in every counter-cyclical event with Canadian real estate. 89 to 94 would be a good example. Took that long. It took 5 years basically for prices to go from peak to trough. It took, I think it was till 2002 for prices to reach their peak again on a nominal basis, on a real basis when adjusted for inflation, which is the other big question mark right now. It took until 2012. So that's like a 22-year period. If that's this position that we're in, which we are, realistically, it's not arguable that we're not going to be dealing with inflation probably for a decade, that in order to deal with that, we need interest rates to continue climbing or at least stay where they are for the foreseeable future to get that inflation under control, then prices can't really continue to grow up.
Right.
Yeah.
I think to kind of bounce off that point or carry on, piggyback from those points, that's kind of like saying the Leafs won the Stanley Cup in 1967 and we didn't win again until, let's say, 2023. Let's just forward think. But that, you can't compare those two teams.
Right.
You can't. You've got totally different players, different coaches, different gear, different equipment, different ice surface, different fans. There's so many different factors at play. So yeah, we can look back and history tells us phenomenal stories and we can make predictions based on that. But the Toronto of 2002 and 94, totally different. I'm Toronto specific, GTA, but those cities are just you can't compare, unrecognizable.
Right.
So there's way too many other different factors at play that when we dig a little bit deeper and look at immigration, we've talked about job growth, we're talking about the supply, the green belt and the lake that we have. Like, we're very confined in terms of the land that we have, right? So there's all those other factors at play that are going to make this asset more scarce, right? Asset being real estate.
Right.
So yes, I agree, rates will continue to go up. That being said, real estate is a lagging industry. The effect that these interest rate hikes are going to have, we don't even know yet. We don't know. No one knows. No crystal ball. Yes, we can look and make educated guesses, but I agree that the market's overreacted to the small hikes we've had so far.
Right. Big
hikes, don't get me wrong, but incremental. Market overreacted, urgency, buyers took their foot off the gas completely, or very much so. Everybody's looking for a deal. Everybody's always looking for a deal. But I mean, my take on a year from now is things will start to normalize probably Q2. Oh, they're already normalizing, sorry. Yeah. They'll start to continue to normalize in Q2. Q3, we'll probably see rates start to come down once again. That's my take. Because I think that these hikes are, I don't want to say an overreaction, but trying to be a quick fix. And you can't have a quick fix in such a dynamic market like our Canadian real estate market.
Right.
So we're trying to have quick fixes. We're trying to appeal to voters and young buyers and retirees and Bank of Canada, we're doing something, we're working on it. It's enough. We got to slow down. We got to let time do its thing. We got to let things get priced in. We got to let these, I guess, actions have their effect. And, you hike interest rates tomorrow, you're not going to see that effect in the market the day after. You're going to see it a year from now, right? So we're doing the right things to combat inflation and normalize pricing, but because we're going too fast, in my opinion, with the hikes, we're going to see them start to reverse that once the desired effects start to take place. So as soon as we see what they want to happen, rates will start to come down again. And I think it's just kind of that, quick fix thing, overreaction and then reaction to the overreaction, right? Too much of that, playing catch up and not forward thinking, too much of a quick fix, which it's painful. You rip the Band-Aid off too quick and it's painful for a minute.
Right.
You know what? It gets better. So that's my take anyway.
Very cool.
Generally.
Very cool.
Yeah. I love both takes on that for sure. Mm-hmm. And now looking for clients that are, investors that are looking to get in the market just at any time, like you were saying earlier, that, it's still a good time to get in. What are your ideal takes on the best investment property to get into? That's regardless of the market going in its peaks or its troughs, it's always going to be cash flow positive or just have great cash flow in itself. And you're always going to be
cash flow
consistent.
Positive is tough,
exactly. But just cash flow in general.
Yeah, it depends. I mean, I sell a lot of stuff in fringe markets, so cash flow is not that hard to find for, the investors that I represent typically. I mean, from my perspective, I think I haven't been able to find a better investment thesis than this, but it's basically, buy a cash flowing asset, ideally a multiplex on a major arterial road in somewhere that's within the province of Ontario's secondary plan system. So basically, something that will eventually be upzoned to a higher density. Let it pay for itself for 1 or 2 mortgage terms and then redevelop it to its new highest and best use, because I agree that immigration is going to cause people the market to always be in a state of excess demand, and we need places to put all of these people. Right. And so we will always need to develop new houses. So, basically buy a place where the piece of dirt can later house a 6-story building, and today it's got a triplex or whatever multiplex on it that's cash flow positive, and let it pay for itself until you can do that with it.
Nice.
Yeah.
I get the thinking 100%. I'm more of a node guy, core guy, Toronto, Hamilton, even Oshawa, Barrie, where there's action, right? And we said everyone, rising tides raised all boats throughout COVID, and people were buying everything and anything and weren't looking at the fundamentals. What do you need? You need job growth, you need transit lines, you need ways to get around, you need schools, you need infrastructure, right? There's certain things you look at in these markets that are gonna add value. Chicken or the egg? What do you build? We build the houses first and then bring everything else later, like a secondary market? No. It's nice to have it all at the same time, right? You want to buy where the action is. You want to buy where the people want to be and want to live. So my take on it is and again, you're saying from a cash flow perspective, I don't disagree from a cash flow perspective, but you can get that as well in a primary market with the appreciation, with the lack of land to add more supply, because if you can build a sixplex on your triplex, so can everyone else on your main street there.
Yeah.
Right? But if I'm in downtown core Toronto, even in a townhome, there's nowhere else to build a townhome. They're not building any more townhomes because everything's condos. So you're always going to be that special asset. And there's always a premium to rent closer to work, right? It's a city-centric model, that trade-off between distance and time and cost. So those periphery markets, I think, are too high. Why would anyone want to live in some of these markets where there's just nothing going on? There's nothing there, right? You want to live in or invest in the primary markets where there's that growth, that demand, that desire, and less possibility to add. That's my take.
Yeah, it's interesting. I would rebut that by just saying pretty simply, like, it's easy to imagine that when you're thinking about everybody wants to move to the GTA and everyone who moves into Canada is rich, but the reality is that that's not the case, and the data tells us that that's not the case. So what's happening is the GDP per capita is decreasing every year, and that's a result of immigration. So basically our economy is becoming less productive on a per capita basis. So what happens is people in the lower end actually end up getting pulled up. So the poverty line gets pulled up by things like inflation in or cost of living raises in welfare programs or in minimum wage. But the top end or the middle of the market starts to be, I mean, this is like what you'd call a K-shaped recovery, right? So the middle of the market, the middle class is basically being engineered out of existence.
Yeah.
And so more and more people get pushed into that lower middle class. Like, I think that the markets that I focus on for the investors that I work with, the thesis is that there's going to be a lot of broke baby boomers, right? And that they're going to move out of cities. So Cornwall, Ontario would be a really good example where we've placed a lot of deals. We buy a lot of multifamily stuff in Cornwall, Ontario. Cornwall's like Keswick or like Barrie, maybe not as big, but for Montreal or Ottawa, it's an hour and a half outside of Ottawa. It's an hour and a half outside of Montreal. A lot of people who need affordability in the rental market or retirement market are moving to a place like that. They can still go fly out of international airports in Montreal or Ottawa. So it's still getting exposure to that same thesis that you're saying, but it's also being attentive to the fact that we're not in a middle class economy anymore. I don't think we're even going to be within the next several decades presenting a first world economy in the Canadian market as a result of a lot of these programs that are going on. And that's just because eventually you run out of economy to spread out with all of the people that live there. And we're seeing the impact of that happening economically right now. And just to finalize that thought, that's why I'm not especially bullish on house prices going up, because house prices are measured in dollars. They're not measured in immigrants, as an example. They're not measured in human beings. They're measured in dollars and the amount of money that those people have. But the amount of money that all of those individuals have is what matters. And so a lot of these markets, like Cornwall as an example, you can go buy a cash flowing triplex at negative land value. So that home is actually, we're buying for $300,000 as an example. To rebuild that house, it would cost $500K. Even if you depreciate it at 50%, it's $250,000. So we just spent $30,000 for that house, and the land basically was free. So to me, it like the same way that people think about the arbitrage of more people will always want to demand real estate in the Canadian market, I think the same thing. If you're saying land scarcity will exist in Canada, which I agree, and it'll perpetuate.
Not Canada, but our GTA, our special.
Yeah, but I would say that I think that'll happen in nodes across the country. And to me, Ottawa, Montreal is a node with greater upside than Toronto.
I just feel that Ottawa hasn't even peaked yet. Montreal is always going to have the language barrier issues that are going to restrict its growth, right? From my perspective, from my thoughts, and those cities in themselves haven't reached their full potential. So the periphery markets, that's overflow, right? The way I see it. So Cornwall from Ottawa, for example, to put it in that perspective with Ottawa, if Ottawa appreciates 10%, Cornwall is going to appreciate 6% at a lesser degree because it's dependent on that node, on Ottawa, right? Just like here, Vaughan is expensive because Toronto's so expensive, right? It's that spillover effect. And we saw very similar growth in COVID, right? The biggest gainers were that periphery at first because we're forgetting that COVID effect, everyone moving out of the city, right? Out of those nodes. And now there's a huge desire to be back because you can walk to Jays games again. You can go to the bar after work again. You can go to work again, right? But I think it's all a spillover effect. I think it stems from those cores. Why would anyone want to live in Cornwall if it wasn't for Ottawa, for example? Why would anyone ever be in Vaughan or Scarborough or some of these markets if it wasn't for Toronto. Right? There has to be that start, that first domino, if you will. And that first domino is going to have the most velocity. It's going to have the most gain, the most upside potential. And then guess what? Yes, that middle class divide, I agree with you, is evaporating. That's what inflation does. The haves and the have-nots. Sounds bad, but it is what it is. This is what these markets do. So the haves or that span are going to be the ones that are living in the core in Toronto, the more desired place to be.
Right.
But do you
Not
think
for
we can
everybody,
sustainably import more haves into Toronto? Like, I guess that's my thing.
The
Is like
quality of
eventually
immigrants
there's a
is
cap.
sensational. The quality of immigrants now, they're coming with more money. They're coming with better education.
Is there actually data on that? Like,
There
I thought the CRS scores, like, which is basically the scoring for economic viability of immigrants, was actually like decreasing right now.
As far as I know, from what I've read and looked at, it's increasing. I know that the quality of immigrants that we want, the application process has gotten a lot tougher. And from what I know, I could be wrong on this. This could be outdated information. But when these immigrants first come to Canada, we try to place them in markets where we want them to flourish and have careers and make money and invest in our economy. But what happens a lot, and there's tons of information on this, is I believe it's a 2-year span. They have to be where they plant them, right, where they start. But after 2 years, when that expires, they all want to be in Toronto.
Yeah, I think it's like
I've talked
basically
to everybody,
50%.
or
Like
at least everyone I talked to.
250,000, yeah.
They all want to be
250,000
here. They all want to be in Toronto because that's where the action. And we're so different from the U.S. in that respect, right? The U.S. you want to work in accounting or banking. There's 40, 50, 60 major cities you can go live and work in, right? So you look at real estate in the U.S. It's a totally different animal. But in Toronto, in Canada as a whole, you've got Toronto. BC, okay, you want to surf at 2 o'clock in the afternoon, go to work for a couple hours and go surfing? Great, no problem. Go to BC, right? It's a different culture. Montreal, the language thing is always going to keep it.
Yeah.
There's going to be a ceiling there.
Right.
Ottawa, you walk down the street, you spend some time there. It's all Parliament buildings. There's no other economy there. There's no other income producing activities happening there. You go off of the main strip and it's like you're God knows where, like you're in the middle of nowhere when you go off that main strip. So no, Toronto is special. Toronto is sexy, and there's a desire to be in Toronto. I don't know how I got all the way to here, but that's the ramble.
Awesome. No, that was amazing insight, boys. Amazing insight. Loved that. If I was an investor and I came to you guys and I said, okay, boys, anywhere but Canada. I know you guys are experts in the Canadian market, but you have, a wealth of knowledge that
anywhere but.
Yeah, anywhere but Canada. You cannot invest my money in, and obviously still the real estate market, but where? Outside of Canada. You had to only pick one city.
Cornwall. Well, I'm just kidding. That's
Malawi.
Where's that?
It's like in the middle of Africa.
Really?
Yeah, so the main, I think the main city there is called Lilongwe, and it's projected to grow to 28 million people within the next 2 decades. So
and what's it at right now?
Sounds lovely.
Like 700,000.
700,000.
Yeah, I mean, the birth rates in Africa are insane by comparison here. Like, so these are economies that don't rely on immigration to grow their economy, like Canada. And don't get me wrong, Canada's nailed it on the immigration side. Like, nobody in the world is offering an immigration program like we are.
Right.
But Malawi's just it's interesting from my perspective. I think that there's a little bit more tied to like that old British colonization, land registry system, et cetera. If you want to invest in land there, you actually have to hire armed guards at the moment to protect the land so people don't squat on it. But putting that aside, so that'd be like $20,000 a year that it would cost you to do that. But putting that piece aside, I just think that the excess demand situation that we're seeing in the Greater Toronto area right now, you would see happening in many African areas and many African cities in the future. That's why China is so exposed to Africa and economically, and they're investing a ton of money in there, the new Silk Road and all of that stuff. And basically they're putting a lot of sovereign debt programs in place for Africa, because I mean that's really where the future growth of the global populace is.
Seems like I've heard the same. Africa is really cool. Lagos, Nigeria. Like I've heard a lot of positive things on the growth and population growth. But I think again, just to combat you, I think it comes down to looking at more than like narrowing in on one stat. Right? Why people love Canada. Just to touch on it, is because of a stable political environment, economic environment, predictable lifestyles. Right? So I think that's the one thing maybe lacking in somewhere like Africa. But when we look at one element like population growth, it looks great. but you want to have armed guards all the time to protect your land and then try to get people to buy your development? Like that's a hard conversation, right?
Yeah,
it's a hard conversation.
We got bigger guns.
Well, you don't actually need
Gotta hit the gym.
you don't need the armed guards like once it's occupied. Like people aren't. There's no like violent crime per se happening.
It's
There's
just
not a lot of
squatter.
it.
No, I'm
But
just
it's like
saying
people,
as
people
a-
will squat.
Yeah.
And take
as
your
another
land,
piece to
yeah.
look at, right?
Yeah.
Like the
No, for
economic
sure, I agree,
climate,
yeah.
political
Yeah.
climate. So I would be more inclined to say, something similar to our market, such as the U.S. But I'm very picky with that as well. I'm pretty bullish on Nashville, Tennessee. That's a market that I like a lot. There's a huge tech industry coming there. You still have the stability of U.S. economy. People like to live there. The quality of life is fantastic, right? I know tons of guys that do their bachelor parties there, and they come back raving about it. I've never been personally, but hey, everybody seems to love it.
Yeah.
The culture is phenomenal there, and I think the outlook, real estate wise, is phenomenal, right? And it's crazy what's going on in Florida right now. So.
Yeah.
Heart goes out to everybody down there for sure, and I hope everyone's safe and the assets are safe. But there's other things to consider, such as climate change and,
Right.
and natural disasters. Right, there's a higher probability of something happening like that in Florida near the coast than Nashville, Tennessee. So I think it's more this is a great question for evoking the thought process and why do we like African communities, right? Population growth and future of the world and world powers, and why do we like Nashville, right? So I think that whoever's paying attention and listening can take that and apply that to their investment goals and strategies.
Yeah.
Right? They can say, okay, what is it that makes these guys look at those markets?
Right.
Right?
Right.
Why are they attracted to those markets? Why is Nashville the first thing that came to mind? Well, the growth in the economy, the population growth, the job growth, things like that. So hopefully that's something that
Absolutely.
people can pay attention to.
Yeah, absolutely.
Yeah. Gentlemen, that was absolutely fantastic. All that information and the insight. Loved hearing it from a couple experts that are absolutely rocking in the real estate industry. And thank you. Thank you very much.
Yeah,
Thank you
thanks
guys.
for coming
Thank
on.
you, Daniel. Yeah, that was great.
Yeah, likewise. Yeah. Thanks for having us.
Awesome. And
Cheers.
before we cut it, let everybody know where they can check you out.
Just Google me. My last name's very unique, so it should be easy to find me. Foch, Daniel Foch.
Similar, you could just Google me, Tyler McLay, MCLAY. Instagram, Tyler McLay Realty Group, or any of my team members. We're pretty easy to find, so Google.
Awesome. Well, thank you again, and thank you again for tuning into this week's episode. Be sure to check us out next week on What Would It Cost? Coming up on What Would It Cost?
A Ladies Touch is a staging and design company in Toronto. We are a full service design and staging company. So essentially we add value to every property that we get the opportunity to work on by using furniture and accessories to elevate the appeal of the space.
When we're staging, we're strictly thinking of the buyer and how to make the property appeal to the masses.
Right.
But when we're designing, everything is catered to the client because it's their home and it's their space, and we need to hear out what they want. But when it's staging, it's strictly what our designers suggest.
Yeah,
because
what complements the home the best,
Exactly.
I think.
Right.
When you're selling, the home should no longer be considered the sellers.
Exactly.
You're
Right.
selling for the buyer.
Right.
And so when you hire a Ladies Touch, we go in there, we neutralize the space to make sure that, as Victoria mentioned, it appeals to as many people as possible.
Right.
I also think it's really important that it doesn't feel like potential buyers are walking through your home. Like
Right.
it shouldn't feel like they're kind of walking through your space or intruding on your home. It should feel like they're walking through their new home.